Hello, and welcome to the Can I Retire Now podcast with your hosts, Nick Russell and Becky Wagoner. I'm your podcast producer, RJ Malik. Now, here's Becky to start this edition of Can I Retire Now podcast.
Hello, and good morning.
Good morning.
Well, Nick, today I've been told we're going to talk more about 401ks.
We are. I thought it was a good opportunity to talk about a little more in depth why they're good, how people mess them up, and little spoiler alert: we have a tool here at our firm that we use to help clients and even people that aren't clients allocate their 401ks.
Oh, so we're going to optimize our 401ks.
We are
401ks.
So let me take a quick just little intro to get people a little why this is. Seems like, why would people need help if they have a financial advisor?
Okay.
So a lot of people don't realize that even as a fiduciary,
Mm-hmm.
I'm not supposed to help specifically choose investments
Mm-hmm.
for accounts that I don't personally manage.
Oh, so a 401k is usually managed by a workplace, not a...
It's usually sponsored by the workplace. And let's say the sponsor is Fidelity, right?
Mm-hmm.
The company that they're using. There may be a customer service number or an advisor attached to the account. And then it's even a touchy subject. They can give you like model allocations, but because they don't know you and they're not acting as a fiduciary, they can't go, oh, put 8% in this and 5% in that and 2% in this.
Okay. So
people are basically on their own.
I was going to say, so who's in charge of the 401k then?
You are.
Okay.
You are in charge of your own 401k.
All right. So there really is wiggle room to make it good or mess it up.
Correct.
Because it cannot be managed by someone whose job it is, basically.
Which is, I'm hoping that evolves and there's some regulatory changes there, because it just seems obvious. Like if I have clients and they're working, why can't I help them like really specifically choose?
Yeah.
So we partnered with another investment firm to offer a tool to help people do this. We'll talk about it at the end of the episode.
Okay.
But why don't we jump in?
So from what I have learned and definitely remembered and did not have to look up.
Oh, excellent. I was wondering, by the way, if you were going to start with what do you normally call 401ks?
Or a wunks.
401ks.
Which is I'm definitely a 90s, raised in the 90s because that's a Friends.
It's a Friends
reference to Phoebe. So 401ks, which I definitely know, is an employee-sponsored retirement savings plan. So this is what's typically offered by employers to help aid in retirement. We did a whole nother episode on the history of it, right? And how it started and everything.
I believe it was episode 4. It was one of our first episodes.
Yeah.
We kind of covered some of the ins and outs of different plans.
Yeah. So it is typically what a lot of people in the United States have as a retirement savings mechanism. Okay. So the 401ks, we're gonna optimize them.
Okay. So, and by the way, we're going to use the term 401k kind of generically. This is also inclusive of 403bs and other employer-sponsored plans known as defined contribution plans, but it's just easier to say 401k. So just for those people that work for not-for-profits, schools, hospitals, and 403bs, we're talking about you as well.
Okay.
So let's start high level before we get into how people mess it up.
Oh, okay.
Let's start super high level. I got some statistics for you because I did my research and I love the
Nick
maths.
Prepared?
Yes. No, I brought it today. So,
okay.
And I can tell you where all these statistics came from. But
good, because you should always cite your sources. The internet is wide and vast. We need to make sure we're using reliable data.
And this all looks pretty on par to information that I get from investment firms and people we do business with. So 56% of all civilian workers, so non-military, participate in a work retirement plan.
I mean, it's the majority, but just barely.
81 or 80, we'll call it 80% participation among those that have a plan available to them. So for those that have a plan available, 4 out of 5 use the plan.
Okay.
Which is great.
Mm-hmm.
I would love that to be 100%, but 4 out of 5 4 or 5 ain't bad.
Yeah.
But you notice that discrepancy, and that's because 90% of firms that have 100 employees or more have a plan.
Yes.
Only 59% of firms that are 100 employees or less offer a plan.
So it's really the people that aren't participating is probably likely because their firm is small and doesn't offer it.
Correct. So we got to give people a little credit. Most people that have a plan available to them are using it.
That's good.
So go people.
Yeah.
Right. Now I heard this as recently as this week, and this gets under my skin so much.
Oh.
I had to sneak it in, and I couldn't figure out where to sneak it into this episode, so I'm doing it now. I had someone tell me that they have a 401k plan at work. I said, great. What are you contributing? I said, I fully contribute to my 401k. I'm like, awesome. So, okay.
What bothers you about that? That seems like a good thing.
What does that mean to you?
Fully contribute.
It's not a trick question.
I guess they meet the maximum amount allowed per year.
Bingo. So let's talk about it. 2026, the maximum amount you can contribute to a 401k is $24,500.
That's a lot of buckaroos.
If you're over the age of 50 or 50 plus, you can add in another $8,000 in catch-up contributions. And I'm sure you remember this from our super catch-up conversation. If your age is 60 to 63, you can actually do an $11,250 super catch-up instead of the $8,000. So if you are 60, fully contribute means $35,750. What this person actually meant,
they matched what the company was offering. So 3% and 3% or whatever.
They're like, yeah, I fully contribute. They match 3%. So I put in 3%.
I mean, I got to be realistic here. That feels like an accurate statement from some perspective, right? Like my company matches up to 3% and I went all the way to 3%.
Yeah. I mean, I don't blame the person for thinking that that's what they're doing. That as we delved into that conversation, just a little behind the curtain, in my opinion, that's the minimum you should put in, right? Get the free money that the company's offering you in a match. They were fully unaware that they could contribute more. And that person is in their 40s.
Okay. So the amount that you can contribute per year, the limit, that's for you individually. It has nothing to do with what your company contributes.
Correct. That's your contribution.
Okay.
Then if your company provides a match, that's on top of that money you put in.
Okay. So the way that they could probably, if they were, let's say it was 3 and 3, he felt like he was fully matching, but he was only contributing $16,000 a year. He could bump that up to like 8% or whatever Absolutely. He needs to. The company would still match the 3.
Correct.
But now he's technically meeting the limits.
Correct.
In your eyes, fully funding.
Fully funding.
Okay.
Fully funding means putting in the most amount. Like if you put in $1 more, the company, the Fidelity or whoever the sponsor is going to go, no, we have to give that back to you. You put in too much.
And do they do that at some point? If
They
you
do.
put too much, like if you just say like, I'm going to crank it and then
juice it up. And then
at the end of the year, they just stop taking contributions?
Yeah, whenever your payroll deductions meet that maximum, they just stop making the payroll deductions.
Oh.
So your net deposit in your bank account will be more because you won't have a 401k contribution.
Yeah.
And it's a really good feeling.
Yeah.
Right?
Not to mention puts more money in your pocket for the holidays, potentially.
Okay.
Okay.
So you mentioned match.
Mm-hmm.
So let's talk about employer matching.
Mm-hmm.
Some trends here. The average employer matches almost 5% of employees' pay. Just under 5%.
That's really generous.
It's more than I thought.
I feel like my match was 3%. So 5% feels good.
But you worked for the state.
Well.
So you got 3%. Plus they gave you a contribution as well.
Yeah.
In addition to that match. So that there were some statistics on that too, but I didn't want to get too
this
too
feels
stat-heavy.
really complicated. Okay.
So the most common match right now in the US is 50% per dollar up to 6%.
Okay, say that in normal words. 50% per, like, what are you talking about?
Okay, so you contribute 6%. The employer puts in 3. They're giving you 50% of your contribution up until you contribute 6. So you put in 6, they put in 3. If you put in 4,
they can do it that way? It's not like a set amount?
Yeah.
It's like an incentive program to save more? They'll put in more if you put in more?
Well, that's how it works on the first, second, third, fourth.
I had no idea. I thought they just said we contribute 3%, period. But if they're saying like, you're in, I'm in.
Yeah.
I had no idea.
That's how most plans work. See, when you work for the state, or like even here in Orange County, the public school system gives a fixed contribution.
I was going to say that was my experience, but I didn't know they could make it a graduated scale.
My employees here,
yeah,
we provide a match based on their contribution. If they only contribute 1% of their pay,
yeah,
they're getting the match on just that 1%. Our match goes up to 6% as well. Once they contribute more than that, the company doesn't provide more, but they only get it if you have to pay to play in most of these plans. So
interesting. So most companies contribute half of what the employee
correct
is contributing percentage wise.
About 40% match the full 6%, 100% of that 6%, and 10% of companies actually match more than 6%.
Go 10% of the companies.
Yeah. So if you are at one of those companies that are matching,
no excuses.
Yeah. No. I mean, it's silly. So match is important because we talked about fully contributing, minimum contributions that you should do at an employer. I don't care if you're fresh out of school, if you're 60 years old, you should at least be putting enough money in your plan to get the full match from your company. Simple math. If that 50% example, you put in 6, they put in 3, you have 9% of your salary in there already. Only 6 came out of your pocket. It's really the only free money that's out there. You always talk about there's never a free lunch. That is as free as money as you get. So definitely take advantage of it.
Okay. So use that.
Use that.
Optimize the matching.
Yes. Couple other quick hitters. Do you know that defined contribution plans, 401ks, 403bs, there's between 10 and 11 trillion dollars in those plans in the US?
No, Nick, I did not know that.
Yeah. Well, this is not it's not a small amount of money is the point.
It's a lot of money, but I had no. If you were to even just ballpark it, I could not have hit that.
All right. What percent of financial assets do you think that represents for
America or an individual?
In America, yeah.
I think that represents 36% of all assets.
It's 32%.
Hot dog! Man. Look at me.
She may not know the answer, but she's a good guesser.
Well, so I'm good at context clues. I thought
the goal here is to know that it's not a small amount of money, right? It is a third of people's retirement assets and financial assets. The average balance in a 401k last year was about $150,000.
Not bad.
But the median balance, you remember mead mode? Oh yeah,
I do.
Is 40,000. So.
Oh no! So there's some real skewed data. We got some big savers, but most of the time they're not. Okay, so what we're saying is
the high income people who are saving high amounts of money
skewing that average,
are blowing that number out of the water
because the 50% mark would be $40,000.
Yeah,
which is not enough to retire on for those at home.
Yes, that's not going to cover a lot of grocery bills. So one thing that is really interesting as you look at it through ages. So the average 40-year-old has about 90,000 in their 401k. Average 50-year-old has 170,000, and the average 60. And the average 60-year-old has about $250,000, 250,000.
Oh, so it really cranks up. But like at 50, people haven't saved
on average have $170,000. Do you want to know what the median is?
No, it feels so low.
60,000
at 50 years old.
50 years old.
That for most people, I would say, is like a 1 year salary.
Your salary or less for a lot of people. Yeah. So the challenge there is, we know you have to start early, save, and earn an appropriate return over time, which is really the focus of what we're going to talk about later, is how do you make sure.
Yeah. I don't want to demean anyone's efforts, but it feels like we could do better.
We could do better. A lot of it's education. A lot of it is just getting the information out there. People don't know that they should start right off the bat, right out of college. They don't understand how the match works. Like
Example 1.
Yeah. You're an intelligent woman. You worked in an office where you had a retirement plan for 14 years?
Yeah.
And this is not obvious to you, right?
Yeah.
And that means it's not obvious to most people. You're my litmus test.
Thanks.
I will say
I represent the average American worker.
Here's my wife. She's so average.
Okay.
I'm going to get in trouble for that. Yeah. So one thing that is going really well is plans have started to do automatic enrollment. I think we had talked about that previously.
Yeah, which I think is the way to go.
People who have been auto-enrolled into their 401ks and have 10 or more years of tenure at their firm have 60% higher balances in their accounts.
I believe it. That was me.
Yeah.
So,
Yeah.
because I just never knew any different.
Yeah.
You just roll and you see all the deductions and you're like, I guess that's legal. And then you just move on and work with what you have.
Yeah. I'll give you
So-
one more stat and then I'm done with stats.
Yeah, you've been rolling.
I'm
out the
rolling.
numbers.
I had my coffee this morning. We're going.
One more.
By 40,
Mm-hmm.
401k savers should be, the recommended amount is to have 3 times their salary in their 401k. And by 50, it should be 6 times their salary.
Yeah.
So you were just talking
We
about that feels
feel like
not
we've
enough.
Yeah, we've talked about this
Yeah.
before if you're trying to gauge. Okay,
But just
so
to gauge that again for people. Last little tidbit, a lot of plans are now offering Roth options as well. So that's after tax, which will be tax-free later, especially for the younger generation, say 20s, 30s, 40s. This becomes, you're in lower income earning years and lower tax brackets, might be a really good option.
can you put into a Roth after you meet your max in your 401k? Or are they the same thing?
They wind up totaling the same amount. If you're talking about the Roth within the 401k, those
Sure,
limits
that's
still apply.
exactly what I'm talking about.
So let's say your max is $24,500.
Yeah.
You could put all of that in Roth, all of that in pre-tax, or any split of the difference.
Oh.
Now, if you qualify for a Roth IRA on your own,
Mhm.
you could also do that. But within your plan, you're set by that dollar limit. But you can splice it and dice it any way you like.
Okay.
All right. I've now bombarded you with facts.
Yeah, I'm giving you the look of
Okay.
I am at my max.
Okay. Max
new
facts
information.
for Becky. All right.
Okay.
Questions. What questions do you have?
I don't have any.
No questions? Wow. I'm such a great teacher.
About 401ks?
Well, about any of that information.
No, we've covered all that before. Thanks for the refresher because I remembered.
All of it, obviously.
Sure. All of it. 10%, same thing. Okay. So how do people mess this up?
Okay. So biggest issues. We touched on a few. Not contributing enough to get the match. Not understanding that they can contribute more than the match.
Yeah, that's a big one.
Well, and by the way, so if you're 30 years old today and plan on retiring when you're 65, on average, you need to save 10% of your income just for retirement.
Okay, so you could do like you said, example, like you contribute 6, your company contributes 3, and we're pretty close.
We're at 9.
Yeah.
Yeah.
Okay.
So then maybe contribute 7.
Yeah.
Right? And that's on average. That's just kind of like a broad spectrum kind of number. But now if you're 40 and you're behind, that number goes up. Maybe you need to contribute 15% of your income. By the way, if you want to do something other than retire, send your kids to college, buy a house. That's why when we talk about spending less than you make and prioritizing savings, you might need to be saving 20% of your income for your goals. Maybe half of that goes to retirement. 5% goes somewhere else. 5% goes somewhere else.
Yeah. Or just starting early when you don't have those expenses.
Yeah.
By the way.
Yeah.
And letting it
It's so much easier.
earn on its own. Yeah. I was going to say, because 10% of your income to meet the minimum of 24, I mean, that's a lot of income that I don't think everyone has.
Yeah.
Right. So there's no way to meet the minimum.
No.
For a lot of people.
You mean the maximum?
Yes, that's what I meant. Meet the 24,000. I mean, that's a lot of money.
The people I know and my clients that are max contributing to their 401ks are saving more than 10%. On average, they probably make,
I was going to say, yeah,
somewhere around there, but there are plenty of clients that are making $150,000 and fully contribute to their 401k.
Good for them.
Well, they're the same people that made 50 and were doing just fine.
Mm-hmm.
Right? Then they made 100 and they were doing just fine. And
so they avoided the lifestyle creep.
Yeah.
Yeah.
They prioritize their savings.
Okay.
The other inevitable thing that people do wrong, and this is kind of what started this whole conversation with us around talking about this today, is the investments, is how poorly the average investor does.
Oh, yeah.
In general.
Because the professional can't manage it for them technically. So usually, and this is the only experience I have, like you're given your options and they usually go like, would you like to be aggressive? Would you like to be moderate? Or would you like to be conservative? And you get to allocate as you want. So you could say like 50% aggressive, 50% whatever, right? That's typically how that works for most people.
It's exactly how it works. Can you guess which option most 70+% of people take? when
I'm
confronted
going to
with
say this, and I
conservative,
don't
moderate,
like it.
aggressive.
They're going to go mostly conservative, half moderate. When really, if you're under 40, you should be pedal to the metal.
So most people choose moderate.
Most people choose moderate. Okay,
Moderate,
that's better
right?
than
All
I
the
thought,
room.
right?
Because
Like
it feels comfortable, right?
it does.
It's moderate.
You're not
Moderate.
risking anything.
Yeah, I'm not being too conservative because I'm told I'm not supposed to do that, but I'm not getting too aggressive either. If I were to tell people to just tell me what their risk tolerance was,
Yeah.
they would mostly pick moderate. When I ask them questions and make them answer questions that lead us to an appropriate risk tolerance, then we're all over the map.
Do people ever split it up? Like I feel like I split mine up.
Yeah, some plans allow that.
Okay.
And then a lot of plans, all plans have the choose your own adventure, right? Like here's your 20 options to choose from. Pick your own allocation.
Yeah. And then I never looked at it again. I maybe looked at it every 4 years.
And you know what people do? They look at the trailing returns, like, oh, how did it do last month, last quarter, last year? And they go, oh, this one's doing the best. I'll choose this one. Investors 9 times out of 10 will choose investments that have historically performed the best. And through lack of education, probably don't understand that markets go through cycles. Whatever did the best last year may not and will likely not do the best this year.
Oh, so changing it may not be a good plan.
Yeah. Following past results is a losing battle. And then there's a whole group of people that are contrarians that pick the things that are doing the worst and think, well, because I don't want to be one of those people, I'll be the opposite.
That doesn't feel good either.
Also doesn't work, historically speaking. Having a broad, diverse model allocation is what wins, and knowing what your appropriate risk tolerance should be. So you're right. You can't tell someone they should be aggressive, right? But you're absolutely right. For anybody, I would argue under 50 could reasonably be very growth oriented, because if we're talking about retirement assets, you got time to play the game.
That language is so much more easy to accept.
Growth oriented?
Growth oriented sounds so much more like opt-inable than aggressive.
Yeah.
I should really change the words on that. This is a PR problem.
It's
really.
a PR problem. I've actually changed our allocation language here in the office to be growth oriented, because I think when you say aggressive, the initial reaction, no matter what dynamic it's in, is negative.
It really is.
You're being aggressive with me. Like, oh,
this is just a PR problem.
Yeah.
Okay. So growth oriented.
Growth oriented, which by the way, comes with more risk. Like there is a logic behind that. And it's not all rainbows and butterflies. But you're right. The younger someone is, the more growth oriented they should be. In general, the older they get, the more conservative they should be. But I feel like you can be as aggressive. Like you can be a 10 out of 10 when you're young. And very rarely does someone need to be a 1, 2, or 3 out of 10.
Yeah.
Like even my retirees, that we're producing income for, and we're doing distributions for their accounts, they might be like a 3 to 5, 6. There's still a need to have growth in almost any portfolio.
Yeah, to not hit the brakes.
Bingo. To beat inflation and keep going. So choosing investments winds up being one of the biggest cruxes of 401ks.
All right.
So 401k plans have started to offer those time, date, target date, retirement date plans, those lifestyle ones that say, oh, choose the year closest to when you plan to retire.
Yes, this is all coming back to me.
Okay. I saw your eyes light up when I said, oh, I know this one.
I've been here before.
So the attraction there is you can put all of your money into that one fund.
Yeah.
It builds a diversified portfolio for you.
Feels secure and safe.
And then even if you choose, I'm going to retire in 2060, well, that'll be an aggressive or a growth-oriented allocation. But every year it'll get a little more conservative, and it'll basically do the work for you. The challenge for me there is when I assess those funds on average, they tend to be more expensive, those internal expenses that you never see, than choosing your own funds. So I would argue, if you're listening to this and you're 25, 30, 35 years old, you don't have an advisor, and you're just saving your 401k, the target date funds, though more expensive, give you a more appropriate,
a better result
allocation.
Good.
Once you're a little more established, if you're working with an advisor especially, or listening to this, choosing your own funds appropriately, of course,
I was going to say,
winds up being a way to actually kind of, I don't want to say cheat a little, but
circumvent.
Yes, some of those extra costs.
Okay.
And so at least on average. So How do we help people who stink at picking investments because they're not educated on it choose their investments? If I can't pick them for them, the sponsor of the plan isn't going to pick them for them, and people don't know how to do it.
Tell me, Nick, how do they do this?
Here we go. So a few years ago, I partnered with a firm that's based out of Atlanta. They're an investment firm. We use some of their portfolios with clients, and they have it's basically a bunch of, it's my people, right? It's math nerds and engineers that
Yeah.
Do their trading, have algorithms. They're just like
That's what they focus on.
Yeah, they're just like statistician monsters, right? So that's their whole bread and butter. So they came up with a bunch of tools to help advisors help their clients. So one that I love is called 401k Optimizer. Very, very, appropriately named.
Aptly named.
So what's nice about this is it can work for every and any 401k plan that's available in the country.
Good.
So literally everybody listening can do this. What the result you get is that every quarter, based on a risk assessment you do, you get allocations to target that risk tolerance using the exact funds from your plan.
That's very specific.
Yeah.
And it's possible?
It's possible.
Okay, so how do they do this?
Very easy. It's on our website. Okay. I try to make this as simple as possible for people. So you go to sunrisewealthadvisors.com. On there, under services, there's a drop-down menu. It literally says 401k Optimizer.
Good.
I'm making this as easy as possible.
Yeah.
Right? You click on that. We have a whole landing page. There's a video about how it works, a brochure about how it works. So it answers all these questions, right? It actually even goes into their investment philosophy around how they choose it's the same models that they use for their multi-million-dollar minimum buy-in models.
Oh,
they make it
like the rich people.
Yeah. So they are recommending things that they would recommend to 100% of their clients.
That's cool.
Yeah.
That feels really level playing field.
It's an insane thing to have access to be honest.
Yeah.
No one else does this. So I love it. So you go there, you can check out the videos, the brochures, all that stuff. There's a link on the page that says, click here to get started or sign up or whatever it is. You go in there, there's a search menu, just choose your company. If your company's there.
Wow.
Yeah, no, this is, I love that you don't know this. This is stuff I do here. So
it makes me feel bad.
You choose your employer. Then they'll ask you to do a little risk assessment to figure out, are you conservative? Are you moderate? Are you
growth-oriented?
Growth-oriented or aggressive? I think they use aggressive. And then they will use the actual funds in your plan and give you an allocation. Every quarter, you can sign up either for an email or a text. They will give you an update. And then in addition to that, because they're again, math nerds, if they feel that the market is in a position that it's shifting, it's either really attractive or really unattractive for a reason, throughout the quarter, they may send you like a off
push
schedule
notification.
Yeah. That says, hey, we're recommending a change. You might want to take a look.
So it will tell you what to do, but it is up to the individual to go in and change it.
Bingo.
But at least you have good intel.
You are now getting.
You're not just really randomly going on vibes.
Yeah. Vibes are out, right? Vibes are out. Facts are in. So now they are literally giving you the allocations. You still have to log in your own plan and make the change. But they're giving you the allocations that meet your risk tolerance. You can always go in and change your risk tolerance. They'll change the allocations and all of that. If your company's plan is not on their search.
Yeah.
Okay.
That's realistic.
It means no one at your company is using their tool. It's fair.
You get to be a groundbreaker.
You get to be the person, right? So all you need to do, unfortunately, this company, they only offer this resource through advisors that partner with them, right? Mm-hmm. So I pay to make this available for clients.
Mm-hmm.
So if your plan is not on there, your company's not on there, or the plan is out of date, let's say the funds have changed or whatever, send us an email.
Mm-hmm.
You can send either we have a service at sunrisewealthadvisors.com. You can email me personally. Send me the name of your plan, like the company, and either like a screenshot of the available investments, or it usually shows up on your statement or on the website. Just give me what the available plan options are. I will send that to them. They will add it into their system.
Wow.
and then you can go in and do your thing.
This is quite a service, Nick.
How great would this have been before you married your financial advisor? This would have been good for you, right?
Probably would have been really good. I mean, I was not doing too bad on my own, but I probably could have been doing a lot better.
You could have been optimizing.
I could have been.
How many times are we going to say that word?
Yeah, that's really cool, Nick.
No, I love it.
I like that.
It does come with a cost. Dun,
Right.
dun, dun, dun.
Like a dollar's cost?
Yeah.
Oh, what's that dollar's cost?
They charge $9 a month for this service.
I mean,
less than lunch.
But if you're making it back because you're optimizing it, yeah, less than lunch. Let's think about it that way.
Yeah. Literally less.
You can't even buy a sandwich
lunch
for less than $11 now.
So, by the way, just as an FYI, none of that money comes to us. I pay to be part of that service, to be able to
be the gateway.
Clients. Their $9 a month basically helps them manage the website and all of that. But I will say, I have pre-purchased 50 subscriptions.
What a generous man.
Well, I'm this serious about it. So the first 50 people that want to try it, when you go on the website, I mentioned it's offered through advisors. So when you sign up, they're going to ask, who's your advisor? Whether I'm your advisor or not, put in Nicholas Russell, my full legal name.
Yeah.
And that'll link you and get you access to everything. The first 50 people that sign up for it, I'll eat the cost for the first year. It'll be free. Try it out. If you like it after that, great. $9 a month. You know it'll be worth it.
Yeah.
So I thought, I'm that passionate about how good I have clients that use it.
Yeah.
There's people on the site that I know use it that I don't know who they are. They're not clients of mine, but they're friends and family and coworkers of other clients, and they love it.
Well, that's really cool.
So
what a great tool.
Yeah, 50 subscriptions. Like, I already wrote the check, so please use it. Otherwise, it's a waste of my money, and I don't like wasting my money.
No, you don't.
All right.
Well, I feel like my fun fact is really not as impressive as what you just pitched. But do you want to hear a fun fact?
Sure. Way to lead into that fun fact.
And we're going to wrap up. No. So, Nick, did you know that we've talked so much about 401ks? I had to search deep. Did you know there's a national 401k day in the United States? I mean, there's donut days, there's everything. But so why not celebrate 401ks?
I taught our daughter last night about mole day. She's learning about moles in chemistry. I did not know there was a 401k day.
Take a guess. When do you think it would be?
April 1st. 401?
One would think.
Oh.
Nope. Wrong. 403B day is April 3rd, though.
Okay.
But no, this is interesting. So this was established in 1966.
First of all, are you promising this is going to be interesting?
No, not at all. But, well, actually, I think the thought process is there.
Okay.
It is celebrated the first Friday after Labor Day to signify the transition from labor and working to retirement.
Oh. Okay.
Oh, I was wrong. It's not 1966, 1996.
96.
Yeah, so 30 years old. Established by the Plan Sponsor Council of America. So it's a chance for companies to engage employees for their retirement planning. And it generally features like a 1% campaign to try to get people to increase their contributions by 1%. Yeah. And also includes what some would consider a fun 4.01K run, which is 2.5 miles.
Oh, like a 5K.
Like a 5K, but a
4.01K
run.
I'll take it. I'm not a runner, so
yeah.
If I can run less, that seems like my kind of race.
Yeah. So I feel like it should have been April 1st, but I can understand.
April Fool's Day.
Yeah, I can understand after Labor Day. Right?
Our original dating anniversary, April 1st.
Oh my gosh, this guy.
The Wayback Machine. You remember that?
Yeah, I do. Yeah, so the first Friday after Labor Day is National 401k Day.
Do you get free ice cream or anything on that day?
If your company has an event for it.
Oh, great. Now I'm going to have to get Kelly's out here or something.
We'll have to think of other things that can be represented by 401ks.
This feels like an offline thought process.
Yeah, I'll have to work on that. But anyway, that is the what some would consider a fun fact.
So if there are any people out there who think it's a fun fact other than Becky, please let us know. It'll make her feel better. So some quick recap, because I know we talked about a lot of stuff here. Most companies offer 401k plans, 403b plans, and all of that. About 4 out of 5 people are participating. If you're the 1 in 5, get your butt moving. The actual maximum contribution you can put in a plan, $24,500. 50 or over, you can add an extra 1,000. 60 to 63, you can actually add an additional 11,250. Most companies match. So at least put enough in there to get the free money from your company. That is literally free money. It's the only thing I can say that anything like that about that in our industry. This represents a lot of wealth in the U.S., most people's retirement assets. So mismanaging that, earning a lower rate of return, making mistakes about how much you're putting in or changes you're making to your plan.
It's a domino effect.
Oh my God. It gets really bad really fast. And we saw it in the numbers about as people age, how their plans grow in value. A lot of people think about, I need $1 million to retire. But at 60, the average person has $240,000, $250,000 in their 401k. That's a huge, huge gap. It may not feel like you're making a lot of progress when you're younger, right? When you have your first $1,000 in your plan and you make 10%, that's $100. That might be like big whoop. But when you have 100,000, it's 10 grand. When you have $1 million, it's 100 grand you make that same 10%. So the earlier you start, the better. And then honestly, I think with the access we all have to our plans, people are going in there, making changes, moving funds around, doing all of that. And it's not their expertise.
And use the right tool.
So use the right tool. So we have one available. Like I said, I made it free for the first 50 people that want to sign up because I already paid for it. If you want, just go on the website, hit the link, sign up. If you're not one of the lucky first 50, it's $9 a month. Or just call me. I mean, we'll figure it out. I want to make sure that people are taking care of this.
So sunrisewealthadvisors.com. Services.
Under services, 401k optimizer. There's videos, brochures. Like I said, it's a great firm that we use some of their investment portfolios for clients. And I love their statistical modeling and how they look at the markets. So, I can't recommend anything to people I don't know, but this is a great tool to be able to use as a resource, whether you follow the recommendations or not.
All right. Well, thanks, Nick.
Hey, Becky, I want to ask one favor of you before we sign off.
Oh.
Next recording,
Mm-hmm.
maybe an actual fun fact.
Oh, geez.
I know. I didn't give you a lot to work with on this one, but
we've talked about 401ks a lot. I mean,
they're
but
important.
I'll work harder.
They're important for all these reasons.
Okay.
So
I'll catch you the Friday after Labor Day, and we'll test out the 401k day.
The 401ks.
The 401k.
All right. Well, thank you for listening. Thank you for putting up with all my statistics and stuff. So
anytime.
Have a great one. And if you need us, we're on social media. You can go to the website. But thank you for listening.
Thanks, Nick and Becky, and we're looking forward to your next podcast. And thank you for listening to today's Can I Retire Now podcast. Until the next time, for Nick Russell and Becky Wagoner, I'm RJ Malik.